It wasn't just the stock market that saw a lot of volatility yesterday. We saw, what happened. The dollar bounced in a decent manner late in the day, and of course, what we saw what happened in gold and in interest rates. And the thing is, so therefore, if that volatility picks up, when you see volatility in the entire market, not just the stock market, it tends to tell you that we're about to hit a more volatile period in general. So if you do see more downside follow through, whether it be today or later this week, it certainly could be cause some serious problems, but cause some problems for the market.
Now, right now, it doesn't look like that's going to be the case. I mean, we're up 262. And by the way, no Russia alleged vaccine news today. So if we are able to rebound and continue that uptrend, does that make you more bullish for the next couple of weeks and months through what is historically the worst month of the year for the stock market?
I think we're vulnerable, to be honest with you. I mean, look what happened with gold yesterday. I mean, it's kind of comical the way some people were trying to put fundamental reasons for this decline. I mean, when the news came out yesterday, they said, well, because of higher interest rates, and let's talk about real interest rate. Well, we had a PPI number that should have been positive for gold. It was higher than expected. Higher inflation is bullish for gold. What happened, though? It was already down, and it got hit even further. Why? Because it was incredibly overbought after a parabolic move. It was incredibly overloved. Sentiment had gotten ridiculously bullish. Everybody was on one side of the boat. It had nowhere to go but down on a short-term basis. Sometimes markets and stocks move for reasons that have nothing to do with the long-term fundamentals. And the reason why I highlight that is that a lot of these tech stocks, these mega tech stocks, have had these similar types of moves. I mean, and I think they're all vulnerable to 10% pullbacks. I mean, and it could be worse when you get the algos get involved. I mean, Apple could fall 20% and still be above its last February highs. It would present a great opportunity, but it would be scary, and it could cause some problems in the marketplace, no matter what the long-term fundamentals might look like.
Let's talk about the presidential election, not from a political point of view, but from a market perspective, because as you note, I'm going to quote you back to you, Matt. How do you like that? Since 1960, there's been 15 presidential elections. In 12 of them, which my math tells me is a lot of the percent, the market tends to rally from about now through the end of the year because politicians on both sides tend to promise a lot of things. Do you think this year, because we have this pandemic you may have heard about, will be any different?
Well, actually, it was the starting date is around Election Day, not right now. The starting date is around Election Day to the end of the year. So people should be looking to buy. As you get, the market may go down if it looks like it's going to be a Democratic sweep. Maybe the market goes down going into the election or immediately after. But people should buy because of the 3 times where the market didn't rally, and the average rally is between 5 to 8%. It's a nice year-end rally. The 3 times, 2 of those times the market was flat. However, the one time where it didn't go up, it didn't rally, was in 2000. That was the year where we had the contested election. So if we go into the election day and you've loaded up a little bit, you want to peel some off very quickly. If it looks like this is going to be a contested, we won't have a declared winner immediately.